All righty, welcome to week one, instructional. So do a little bit of a housekeeping, make sure everybody can get here. So within the Blackboard, you should be able to go to courses, see the principles of accounting. And then if we go to start here, sorry, course content, you'll see the syllabus and the module for week one. Within here, you have all the reading and assignments. Again, we'll be going over chapters 1 and 2. You'll have some videos and some presentations. And then you'll need to go to the learning activities and assessments. Course attendance reviews due Wednesday. Introduce yourself by Sunday. Have an opinion here to write. And make sure that by Thursday, and then make sure that you have 2 replies by Sunday of each of these SMART assignments. And in this instructional, we're going to go through the week one homework assignment. Now, before we get into these questions, I did want to give a general overview about what this week is. So with accounting, you're going to learn the reason I love accounting is because for every debit, there must be a credit. We call this the Zen of accounting. And this is really as complicated as accounting gets. Our assets equals liabilities plus owner's equity. This is known as the accounting equation. Throughout the semester and throughout any other accounting course that you're going to go through, this is the general basics. From here, we're going to complicate it by having more assets, different types of liabilities, learn the different ins and outs of equity. Now, when we talk about equity, it's everything that the company has earned plus everything that the owners have put in. So we call that retained earnings and capital. And then under retained earnings, we have income and expenses. So everything we've earned minus everything that we paid. Okay. At this point, you're probably wondering what all these arrows are. This is the debits and credit side of things. Starting out with accounting, you should treat this as a foreign language where you're learning definitions. It means bring your flashcards out, each new word, learn whether it's an asset, liability, or an equity, put whether it's a debit or a credit, and how those interact with each other. It's the only way you're going to get through this semester is by learning how to speak as an accountant. You'll notice on the asset side, the left side is what we call the debit, the right side is what we call the credit. For an asset, debits increase, credits decrease. Now, I drew this line here because on the other side of the equation, you'll see everything is exactly opposite of that. Debits decrease liabilities and decreases equity. Credits increase them. However, just like with math, there's that negative sign here, so everything on that side is going to be flipped. So the expenses are actually going to be treated just like the assets, where the debit is increasing and the credit is decreasing. So with that, we're going to go through the questions for this week. Now, each of y'all will have different questions as this comes up, but the goal is to kind of talk through each of them and make sure that you understand why it's being asked, and hopefully that will help you through your assignment. So the first one, we're identifying items and accounts from the list that are to serve as source documents. Okay. It's important to know the difference between a source document and anything that we prepare from that moment on. Okay, so source document is going to be something specific that indicates evidence of a transaction. And from there, we'll record that transaction and we'll report that transaction, but we need to know what creates a transaction and what is simply reporting it. So you go through this list: sales ticket, that proves that a sales occurred, that is a source document. Trial balance, we'll get into what the trial balance is. It's a listing of all of the accounts that we've had and what their current balance are. And then we show how that balance is. So that's not going to be a source document. That's going to be something we use to help report it. Same thing, the balance sheet is the representation of this equation that shows that the assets equals the liabilities and the equity. So again, that's going to be showing something reporting that. Telephone bill, that's a source document because it shows the utility usage for that month. An invoice from a supplier, again, that shows that we owe something, so that's evidence of a transaction. Company revenue account, so revenue is what we've earned, and the account is a listing of what we've earned. So again, this is going to be reporting on it. Same thing with the income statement. The bank statement, in that we'll see the transactions that occurred for that month, and that's going to be a source document because things like interest and accounting fees will only show up on that bank statement. And prepaid insurance is an actual account. So if it was the invoice for the insurance or something like that, we'd say it's a source document, but this is the reporting of that account. Okay. So again, the question on a source document is whether or not it provides proof of the transaction or if it's just merely reporting or identifying that transaction. A different question there. Okay, identifying the following users as either external or internal. So for accounting, we need to make sure that we keep the distinction between internal and external users. Internal users, by definition, are going to be privy to a little bit more information, and they're going to have to see things in a specific view. And we can modify it a little bit more for internal users because those are our employees or our management or our board, and they're privy to the day-to-day of the operations. And so we'll be able to report a little bit differently. External users are the investors, the banks, and any regulatory bodies. With that, we're going to have to be very specific on how we report to them. And there's certain principles and guidelines that are more stringent when you're reporting to an external user because they might not be privy to the same information, and we don't want to miscommunicate anything to them so that they understand what's being reported. So as we go through this, again, officers, that's going to be internal. Again, government's external, customers are external, employees, internal, our own managers are internal, external in the definition is external, any of our managers are internal, regulatory bodies is external, and all of our managers are internal. So again, the internal users are going to need the information for the day-to-day, and we're going to prepare it to them specifically in that regard. External, we're going to have to follow the guidelines and principles. All right, question 2, journal entries. So again, always think back to this as you're preparing the journal entry. Once we've identified that a transaction has occurred, we're going to have to do the debits and credits to record this transaction. All the debits has to equal all the credits, and we're going to choose the accounts for which the transaction occurred. So we go through here. All right. So Tanner invested $95,000 cash along with office equipment valued for the company. So our cash is an asset that's going up, so we're going to have to debit that. We're also receiving equipment. Equipment is an asset, it's going up, we're going to debit that. And in return, Tanner's not giving this for nothing. He's now going to be part owner of the company. And with that, we call that capital, and his capital is increasing. So we're going to credit that. Next one, we prepaid for 12 months rent on the office space. All right, so they give you the hint that we're going to debit prepaid rent here. It's not an expense at this point, it's an asset, because in return for this $7,200, we get to live in this place for the next 12 months. So we're only going to recognize that expense proportionately over those 12 months. So the debit to the asset, and of course we have to give up cash. Cash is going down. Cash is an asset. We're going to credit it. Next one, the company made credit purchases. So credit purchases is accounts payable for office equipment and office supplies. Okay, so again, our equipment and our supplies are assets. They're going up. We're going to debit them. And the credit we now owe this company, that's a liability. We're going to credit that to go up. We completed services for a client and immediately received $2,000 in cash. Okay, so we received cash. Cash is an asset. That's going up. We generated revenue. Revenue is an income account. Credit that to go up. Same thing, we completed another project, and this time instead of paying us right away, we're giving them 30 days. So that's called accounts receivable. That's an asset, it's going up. And again, we're generating revenue, that's going up. And again, as we're going through these, each time you see a new account, we should be making a flashcard. We should be noting whether it's an asset, a liability, or what account. We should be noting whether it's a debit or a credit normal balance. That's going to help you throughout the semester as we get more and more complicated accounts. All right, then we paid cash to settle the accounts payable. Okay, so the accounts payable is now going down. It's a liability, so we're going to decrease it by debiting it, and in turn, we're giving out cash. We then paid cash for the premium on insurance. So again, we get to have that insurance for 12 months. We're going to recognize that expense equally over those 12 months. So, but for now, we have an asset, and we gave cash for it. We received cash as partial payment for the week. So here, the accounts receivable is going down because they're paying on it. They no longer owe us that amount. Okay, yes, that's right there. Increase cash, decrease accounts receivable. Then we completed work for another client on credit. So AR is going back up, service revenue, same as the last time. And you'll notice this does get repetitive because the point is you have to get the basics in order for us to get into more complicated accounting, to where we get depreciation and different assets. So we're going to repeat it, and so that becomes second nature. And again, those flashcards are going to help make that happen. Okay, here we withdrew cash from the company for personal use. Okay, so here they took cash, so that's a credit to the cash. And here we're reducing our capital because we're taking the money out of the company. So we're going to debit that capital account. We're going to keep the deposit and withdrawal separate. So you'll see this account is labeled different than this account. And that's just so we can keep a running total. Office supplies. So until we use the office supplies, that supply is an asset. We're going to debit it. And again, we owe that money, so we're going to increase our liability. Then we have the utility bill. So for that month, that's an expense. We debit an expense to increase it, and we paid that bill, so it's going to be a credit to cash. All right, so these are journal entries. Remember the format. You have your date, your numbering, each of the accounts. We always indent the credit account, so that way we can keep it separate. Debits go on your left, credits go on your right. Once we have each of those accounts, you'll be introduced to a T account, which is just a running total of that specific account. You list out all of the dates that you debited it, all of the dates that you credited. And then from there, we'll take the total at each of these balances and create our trial balance, which is just the listing of the accounts, the total of the debits and the credits. You know if you did it right, if your debits equals your credits. Okay? This will be a pretty good example of what your assignments are going forward. All right. And again, identifying normal balances, we're trying to get this to be second nature to you. So as you go through these, until it's second nature, have your little chart. So owner withdrawals, so that's going to be a capital, except the withdrawals, it's a negative capital. So the debit is going to be the normal balance. Prepaid rent, it's an asset, debit. Owner capital, that's a normal capital, credit. Prepaid service fees, that's an expense, debit. Utilities payable, payable means it's a liability, credit. Prepaid parking, prepaid, that's an asset, debit. Taxes payable, payable, liability, credit. Supplies, asset, debit. Interest payable, payable is a liability, that's a credit. Okay. When we say normal balance, we're talking about what's on the left side here, or what side makes it go up. Okay. Okay, fraud. Can't have an accounting course without talking about fraud. This is why accounting becomes quote unquote exciting. Anytime a movie is made about accounting, it usually involves fraud. What that means is that we're using accounting to hide transactions that are considered illegal. And mostly that's embezzlement, just misappropriation of assets, reporting infringements. It could be a wide variety of things, but the goal is to enrich someone without proper reason. Okay, so what we call the fraud triangle is the three things that are necessary in order for someone to commit fraud. What those are is opportunity, pressure, and rationalization, which means someone will commit fraud only if these three conditions are present, meaning that they have the opportunity, can't commit fraud if they physically cannot do it. Pressure, meaning that there's got to be some reason to do it. Most is financial pressure, at the family to keep, they have bills they have to pay, could be someone's pushing them along to do it, whatever the reason. And then rationalization. A person generally will not do something that they consider wrong unless they have a reason to do it. And the rationalization starts out just a simple seed, but once they're able to overcome and say, okay, I can do this because, then nothing else matters. And they're able to go ahead and do their behavior. And so it's important as we go through this, through the accounting cycles, to minimize the opportunity, pressure, and rationalization given in order to prevent that fraud. Okay. So the business has no cameras or security devices, meaning that there's no one there to stop them. So that's going to be an opportunity. Managers are expected to grow business or fired. Being fired is definitely a pressure. A worker sees other employees regularly take inventory, personal use. Well, everyone else is doing it, so that's rationalization. No one matches the cash in the register to receipts when shifts in, so it's an opportunity there. No one's matching it. Officers are expected to show rising income or risk dismissal. Again, risk dismissal, that's pressure. And a worker feels that fellow employees are not honest. Well, again, if no one else is being honest, why do I have to be? It's a rationalization. So again, these are just matching up definitions. Again, flashcards are the best way. So it's called accounting because all organizations set up an accounting information system to communicate data to help people make better decisions. It's the language of business. Business activities requires communication, so we prepare accounting reports such as financial statements. And again, communicating. So the financial statements is just how we communicate to external investors how the business is doing. That's a communication tool. Business activities require that we select relevant transactions and events. That's identifying, because we need to know what are relevant transactions to create those journals, to go through those statements. And just definitions here. Okay, so there's 3 steps to the accounting. It's identifying, recording, and communicating. So they're asking you for each of these activities, which of those 3 categories is it? Analyzing and interpreting results. Again, that's going to be communicating. We're going to be presenting those financial statements. We're going to communicate what those results are. Presenting financial information. Discuss communicating. So keeping a log, that's recording. Measuring the cost, again, recording. Something's already happened and now we're recording those transactions so that we can get to the communication phase. Preparing financial statements, communication, and then the rest are identifying. Seeing revenues is identifying the fact that a service was provided. Observing employee tasks behind in a product. And registering cash sales or registering cash sales of products sold is recording it. Okay, so we did that one in the last. Hopefully we switched it to the screen. Okay, so now we're identifying the effects. So again, we're going back to this, the assets, liabilities, and equity. So now there's also things that impact the income statement and the statement of cash flows. So the income statement is going to just be this side of it, the income and expenses. And then the cash flow statement is anything that impacts cash. We segregate those impacts by operating, investing, and financing. So the operating activity is the day-to-day. So cash comes in from customers, cash goes out for suppliers. Investing is what are we doing with our money for the future. So that's purchasing equipment, selling off of equipment if it gets to it, things like that. So it's important to know the distinction between investing and financing. It's sometimes confusing because sometimes those words are meaning the same thing in our day-to-day life. But the investing is what are we doing for the future of our business? What are we using our cash for the future? And then financing is how do we go about keeping the cash flow for the company. So this is going to be external financing. Either the bank is loaning us money or our owners are putting in cash or taking cash out. It's the external, how do we get this cash to do the investing and the operating. Okay. So owner invests cash, cash is an asset, it's going up. The owner is doing this, so that's equity. He now has higher stakes. That's going up. And again, that's an external financing. That's how are we getting the cash to do this? We received $700 cash. Cash is going up. It's an asset. or services provided. So here, remember that assets have to equal liabilities plus equity. So this part of it always has to balance. Our cash went up because our income went up. The income flows through into the equity, and that's going up. So that's why you have a positive here. It's going up because you had income, so that's going up. And cash came in the door due to an operating activity. So that's going to be 700. Now we paid cash, so cash is leaving, so the assets are decreasing. For employees' wages, wages is an expense into equity. It's decreasing our equity. It's an expense, so it's going to be shown as a negative on the income statement. Again, cash is leaving the door because of an operating activity. Here we incurred $100 in legal costs on credit. So we haven't paid it yet, so cashes and assets aren't impacted. But we now owe more, so our liabilities are going to go up because of an expense. So our equity is going to go down. Our income is going to show negative. And cash did not leave the door yet, so we have no impact here on the statement of cash flows. Purchases $200 of suppliers on credit. So our assets are going up because we have accounts, we have supplies. Our liabilities are going up because we now owe them, and no other things that have occurred. We still have those supplies, so it's not an expense. It's an evening, and we haven't paid anything in cash yet. Now we buy equipment for $300 cash. So our assets are actually going to be even. We have plus and minus 300 because cash is leaving the door, so that's going down, but we're getting equipment, so that's coming up. The only other operating, it's an investing activity because we're buying equipment for the future. So cash is leaving the door, so it's negative for investment. We paid $200 on the accounts payable, so our cash is leaving, that's going down. Our liabilities have reduced, that's going down. And now we have the cash flow impact for an operating activity of decreasing. Provide services on credit, so our AR is going up. Our revenue for our equity has gone up. Positive on the net income. We didn't receive that cash yet, so no impact here yet. And then if we withdraw cash, cash is going down. Equity is going down because he has less stakes now. And that's a financing activity. It's just the negative of this. Then we collect $400 cash on receivable. So at this point, our assets are actually equal because our cash is going up, but our AR is going down. What's a plus or minus 400 here? Plus and minus 400. And now cash has gone through the door, increasing our operating cash flow. Okay. And again, this should be part of that flashcard. What goes up and what goes down. What are the following steps in the accounting process that focus on analyzing and recording transactions? Okay, so this is just that accounting cycle, which order of events happens first. Okay, so you can see, analyze each transaction from source documents. So we have to have the source document that shows a transaction has occurred in order for us to analyze it. That's the very first step. You have to have something that triggers this process. Once it's triggered, you're then going to record it if it has a relevant transaction using your journals, debiting and crediting the accounts that were impacted. We're going to post that journal to the ledger, meaning push it through to the T accounts and push it through to open up that to update that trial balance. And then once we have that trial balance, we're going to prepare it, and then from there we can make any of our financial statements. Okay, and that completes your homework for week 1. Let me know if y'all have any questions, and I will see y'all next week.